Mac. It's time to talk about financial assets and investments. What do you do with your money and where do you put it? It does matter. So, as we go through this, we have to talk about some obvious words that might not have obvious meanings to you unless you really think about it. First of all, saving. Saving is the absence of spending, right? That's the verb. But the noun, if I say savings, what I'm referring to are the dollars that become available when you stop consumption. When you don't buy things, you're saving. Okay? Wealth is what we say, it's our accumulated savings. If I save up $100 a month, what I'm doing is I'm saving and I'm creating wealth. I can also refer to that as assets. I can have physical assets or financial assets. A physical asset is like your house, your boat, your car, your vacation home, whatever it is. But a financial asset is a paper holding where I've taken my money and I've committed it to something that would give me a payoff in the future. And the last thing we need to know is that investments are using assets to earn income or profit. So I'm not just holding on to them, I'm manipulating them in a way that will earn me money. So we have to talk about the savings, investment, spending identity, which sounds really fancy, but it's pretty straightforward. So in a simple economy, we know that total income is equal to total spending. If you remember, we talked last unit about total income being consumption and savings. Either you're going to consume or you're going to save. It's one of the two things. Well, we also need to talk about if I choose to spend, I could be spending on either consuming products and shirts and cars and a hot dog, or I could be investing my money and putting it somewhere. So if you kind of go, well, are these equal? The answer is yes. Consumption plus savings would then be consumption plus investment, which tells me that savings is investment. If I'm choosing to save and not spend, I am choosing to invest. Whether I invest in cash, whether I invest in my savings account, or whether I invest in a larger payoff of an asset, I am actually investing every time I don't spend my money. So, in a financial system, you have to understand, if I want to expand my business, those physical capital investments have to be funded somehow. If I want a new wing on my factory, if I want a new robot on the production floor, if I just want to increase the capacity of my factory, I have to get money somehow, and most of that's going to be through borrowing. So there's three things that the financial system is looking to do. Number one, reduce your transaction costs. Number two, they're looking to reduce your risk. They're looking to reduce your financial risk. They're also looking to help you diversify. For example, if I put all of my money into Home Depot stock, but they go bankrupt, then I'm also not going to have any money. The third thing is looking at liquidity. So when we call an asset liquid, what we're saying is I am capable of turning it into cash and using it quickly. So a liquid asset is like cash, a savings account, a checking account, or maybe a short-term thing that you can turn into money when needed. An illiquid asset is something that you're going to commit to saying, I don't need to touch this money for 5 years, so I'm going to invest it with you at a higher interest rate. So when we talk about financial asset markets, we have to talk about markets in two groups. The first group, I'm going to classify markets according to the length of time for which the funds are lent. So you have a capital market and a money market. A capital market is if I'm loaning money for longer than a year. If I'm committing to a year, 2, 3, 10, 12-year loan or 12-year bond purchase, that's going to be in a capital market. In a money market, money is lent for periods of less than a year. I can also classify markets on whether or not you can resell that asset to a buyer. If I am participating in a primary market, I am swapping and I am investing in financial assets that cannot be transferred from the original holder, as opposed to a secondary market where I can take financial assets and when it's time for me to turn them into money again, if it's not quite time for the investment to be over, I can turn that into money by selling it to somebody else. So, what we need to talk about are financial intermediaries. Financial intermediaries help to channel funds from savers to borrowers. These are like banks, savings and loan associations, credit unions. We'll talk about this in a lot more detail later this unit. Now, there are a whole series of non-bank financials. These are financial intermediaries that are not banks. So the first one is like a finance company. These finance companies are going to make risky loans to consumers and small businesses, but because you're risky, they're going to charge you a higher interest rate. Think about like a payday loan association where you go in and you say, I'm getting my paycheck in a week, but I need cash now. That person's going to look at you and they're going to say, you didn't save your money for a whole month. You ran out of cash. giving you money is going to be kind of a big deal. You're pretty likely to not pay it back or to have problems paying it back. So I'm going to charge you a higher interest rate. Same goes with like a bill consolidation loan. Oh, hey, you've got $20,000 here, $10,000 there, and $1,000 over there. I'll consolidate those loans, but it's going to be at a higher interest rate because you're risky. The next one is a life insurance company. They're going to provide financial protection to the family or any other beneficiaries if you're injured, if you die, if something goes wrong. They collect a lot of dollars in cash because you're investing in your life insurance. So they also often lend a lot of that surplus out to other people. Some other non-bank financials are like mutual funds. So if you can't afford yourself to have access to a big variety of investments, a mutual fund will let you buy a piece of stock in a mutual fund. So you and 1,000 of your closest friends or 1,000 people you've never met are all going to pool your money to invest together. This neutralizes your risk. It allows you to hire better staff to help to manage your money, and it takes away a lot of the unknown because a person with a lot of knowledge is going to handle that for you. The last thing on here is a pension fund. This is if your employer is going to collect deposits as you work, and then when you retire, they're going to distribute that back out to you. So, when you invest in your future, one of the things you need to know is something called a 401k. A 401k simply refers to the section of the tax law that is establishing this rule. So a 401k is a tax-deferred investment plan that acts as a personal pension fund. So you can put money into one of these accounts and it's tax-deferred, which means you don't pay income taxes on it until you actually withdraw the cash from the bank. About 80% of employers will actually match your personal savings as you put it away. So if you put $50 in and they have a 100% matching program, they're also going to put $50 into your investment because they want to help you invest in your future. So when you're investing, one of the things you need to know is to kind of how do you look between the various assets that are available? Well, the first thing is a risk and return relationship. Is it super risky? Is it something you can manage? Or is it something that you're kind of worried that it might fall through? The question is it worth it? The next thing you have to look at is investment objectives. Do you have liquidity or do you need it? Where's the money come from? What's your personal situation? What works for you may not work for somebody else. The one that I'm always big on is simplicity. If you don't understand the investment, you shouldn't be being involved in it. The next one is consistency. Are you in a situation where you need an investment that's going to pay you off a little bit every month? Or is it something where you can just sock away money and not have to worry about it? And the last one, the big one, is diversity. You want to make sure that you're investing in a variety of different things, just in case something doesn't work out the way you want, something else may be able to make up the difference there for you. So the last thing we have to talk about here are bonds. We're talking about bonds. We're not talking about Barry Bonds, James Bond. We're talking about financial assets. So you remember from history class, we talked about buying war bonds. We talked about buying war bonds. It'll help the war. It'll help you sink the Japanazis with bonds and stamps, right? Well, what we know is that bonds are actually pieces of paper. And during World War II, as with many other wars, we were actually selling bonds as financial assets. You can buy a bond that's not a war bond, but basically this is an IOU. They represent debt that the government or a corporation has to repay to an investor. So they have three basic components. There's a coupon rate, which basically is what is the interest rate that you're going to be paying back to the person who invested. You have maturity. How long is it going to take until they owe you your money back? And a par value. How much did the investor pay to purchase the bond that's going to be repaid at maturity? So if I buy a bond that's going to be worth $1,000 in 20 years, that's my maturity, 20 years. The coupon rate, the question is, if I'm paying at 5%, 1%, 3%, how much par value do I pay now to be able to get $1,000 later on? So we do some math there and we say, okay, I'm going to pay you $850 today, and in 5 years, you're going to pay me back $1,000 because that will be my investment plus interest. Bonds all have basic components to them where they're going to tell you on the front of them who's the company, when is it mature, how much will it be worth, What is the interest rate? And it's going to be a very official document that literally represents your money. So Standard & Poor's and Moody's are two of the biggest bond rating companies that are out there. A high bond rating basically says you have a really safe company, you're definitely going to repay it, you're a good investment. A lower bond rating says, ooh, this company's kind of sketchy, you may want to reconsider it. So Standard & Poor's and Moody's are slightly different setups if you look at the graphs here, but basically they're going to say, how safe is your company and how are you doing? Below the B level is what we call junk bonds. These are really high risk bonds. So if you're going to invest in these companies, they need to pay you back a really high interest rate to make it worth your while. So the way I always like to talk about bonds is talk about a lemonade stand. So let's tell you a story. Pretend you're going to start a lemonade stand and you need some money to get your stand started. What are you going to do? Well, you go to your grandma and you say, lend me $100. And on a piece of paper you write down, I owe you $100. I will pay you back in a year plus 5% interest. Your grandmother just bought a bond. Bonds are loans or IOUs that represent the debt. Okay? The bond holder has no ownership of the company. So grandma can't tell you how to make your lemonade. She can't tell you that your sign looks messy. She simply gave you dollars to do your business. But now if you need more money, you have to really think about where you're going to get it from. Maybe a bond isn't the best idea. So in this case, to get more money, you sell half the company to your brother Tom. You're going to say, for $50, you can have half my company. You put this in writing. Limo is going to issue 100 shares of stock. Tom will buy 50 shares for $50. So I owe half, he owes half, we're all good. So he just bought 50% of the business. He's allowed to make business decisions. He's allowed to get some profits. He's allowed to be part of this. So if you own stock, you can profit in one of two ways. You can either get a dividend, which is a portion of the profits, or a capital gain. So if he bought a share of stock and each share of stock was worth $1, well, if your company grows in size and grows in value, so each share of stock is worth $5, he's going to sell off his shares, and for every $1 share of stock he bought, he's going to sell it for $5. So he's had a $4 capital gain in the course of being part of your business. Now, if your business doesn't do so good, it starts to get a lot smaller, and he sells it at a lower price, we would say suffer a capital loss. Now, shares of stock are beautiful. Every company issues one that looks a little bit different. It's very unique to the company, but these represent your investment, so you want to make sure you protect these. You can also get online stock reports that will tell you, well, how much is this share of stock worth? It will show you things like, what is the current price of the stock? How much has it changed today? You'll see, well, it's been worth between $524 and $539 today. Over the course of the last year, here's how much it's been worth. You can always follow a chart that zooms in for different amounts of time as you look at these stock reports. So you can follow how they do and you can look at what's going on there. As we look at the performances of stocks, we have what we call bull markets and bear markets. When the stock market rises steadily over the course of time, we call it a bull market. If it's consistently falling, we call it a bear market. How do you remember this? You think about how they attack, right? What is the bull going to do? It's going to bow its head and it's going to charge up with its horns to try and take you out. How does the bear attack? It's going to rise up on its hind legs. It's going to slash down with its hands. So you always see bulls as the symbol of people who are companies that deal with the stock market. There's a big bull on Wall Street. Why? Because that's what we call a bull market. We always want to represent that growth side of things. So stock performance indexes, there are two really big ones. The Dow Jones Industrial Average is an index that looks at 30 companies and they say, how much have they changed in value? To give me an idea of how industry is doing. The S&P 500 is another one from Standard & Poor's, and they're an index that tracks the performance of 500 stocks to get really a heartbeat of what's the economy up to. These indexes can give you an idea, did they go up, did they go down, and how much have they changed, to see kind of how things are going. In this case, you've got a screenshot here where the Standard & Poor's index is just going up and up and up. Life is pretty good over the course of time, but you'll see over the course of days and weeks and months, sometimes you do have a decrease, but overall the trend line is for an increase here. The stock market can give me a good idea about the health of the economy. Great example of this, think back to your U.S. history classes. When the stock market crash happened in the 20s, what happened to our economy? It went bad. Why? Because people lost confidence in businesses and in their investments. So it's really important to track these investments to get an idea of what's happening. There's another big stock market crash that happened in the 80s. You may have read that as one of your choices from the Market Crashes and Bubbles article that you read a couple weeks ago. But there are some crashes that are just not the same. This is a screenshot from the Apple flash crash that happened a couple of years ago. What happened is you were trading and trading and trading, and all of a sudden, do you see this big giant decrease that happened? It dropped all the way down. Then all of a sudden you had this big rise back up where the market corrected itself very quickly. And that could have happened for a couple of reasons. There could have been problems with the trading system. There could have been one person who owned a lot of the stock and they sold it off all at one time. But the bottom line is all stocks are volatile all the time. So time is a big factor. If I want to compare how a stock is doing, this is a stock over the course of 5 days. Well, there are some days where it did pretty great, and there are some days where it really didn't. If I wanted to buy this stock, I would have bought it down here where it was somewhere in the lowest, and I would have made money as it grew and grew and grew here over the course of the next couple of days. Well, if I take that and I say, okay, instead of 5 days, what's the course of 6 months? Whoa, over the course of 6 months, we're actually not doing so bad. You do have an upward trend, but you want to make sure that you're really following how they do. Over the course of a year, well, yeah, they're mostly growing. Over the course of several years, you see that the stock, if you hold on to it for a long time, it will have gone up and down and up and down. But in general, over the course of a couple of years, this sucker's grown a whole lot. That's a pretty good investment for you if you're willing to hold on and stick with a good company. So what does this actually look like in real life? Well, you've got a whole series of stock exchanges. A lot of these have gone digital, but what you're looking at is the big one is the New York Stock Exchange, the NYSE. This is stocks for the largest and most established companies. You've got the NASDAQ, which specializes in high-tech and energy stocks. You have what we call the OTC market, which is a marketplace that's not really listed on an organized exchange. It's a place to swap stocks that aren't those big booming companies. You also have a lot of people who participated in day trading. This is using computer programs to try and predict price changes. Think about sitting around in your sweatpants and watching numbers all day long. But if you're really good at it, you can make a lot of money by investing and being a day trader. Just don't get sick or take a day off, okay? Hope this helped out a whole lot. Make sure you understand what you're up to so that we can apply this in class the next time I see you. Thanks. Bye.